Good morning, everyone. I'd like to welcome you to our webinar today. Today we'll be speaking about the Biden administrative tax plan. And I'd like to thank Alberto Guzman and Eric Linsky, as well as Elliot Lowenstein, in joining us in this presentation. For purpose of just housekeeping, we've set aside 10 minutes. For any questions, you can feel free to send them to me, and I will go ahead and disperse it to the persons that are going to be answering. If not, I'll answer it myself. Thank you for participating, and without further ado, I turn it over to Alberto.
Good morning, everybody. Thank you for joining us. This is interesting to do a presentation here on sitting in my office, but this is what we have, and this is what we'll deal with, and we'll make the best of it. So as Ray mentioned, we'll be talking about the changes that are coming, and for clarity, we're going to be talking about several changes, but I want to be specific. And there's certain things that are current law. There's certain things that have been proposed on the Green Book, which basically has to do with a proposal to Congress to take to a vote. And then there's other items that have to do with items that have been referred to in the Biden campaign that we think are going to end up being part of the actual tax code at some point, but we don't know. And even with the Green Book stuff, we really don't know how it's going to pass. We have an idea of how it's going to pass. So without further ado, I'll start getting into the key points, and later we're going to recommendations based on those points. Can I get the next slide, please? All right, so here we have a picture of what our current tax rates are. Talking about the highest tax rate is a top rate of 37%. You guys can see that in the slide. The proposed rate, again, goes up to 39.6, and you can see the thresholds for married filing separate and single filers. This is not a huge change. It's a change. This pretty much brings it back. If my memory doesn't fail me, I was only 20 years old, I think, but that was Clinton's rates. Ray, you were a little bit older, I think, but I think those were Clinton rates roughly. So it's not a huge change. It's a change, but not a huge change. The next one is a big change. This is capital gains and qualified dividends. As you know, we have capital gains rate of today of 0, 15, and 20% rate. And for dividends, the same applies. For qualified dividends, that is. That rate, it's set to go away for the high income earners, and those will be the $1 million and up for married filing jointly, or even sorry, 500 for the married filing separately. What that means is that once you hit that threshold of adjusted gross income, you essentially cannot benefit from the capital gains rate, and you're going to have to pay ordinary income tax rates. Allegedly at that level will be 39.6, because you will be at the highest tax bracket. This part of the law, and this only part, and it's not the law, let me clarify that this is part of the Green Book. This is the only one that has some verbiage in it to be potentially effective April 28, 2021. Yep, it's not a typo, it's 21. This is huge. This I haven't seen this since maybe Elliot and Ray have. Since I haven't seen this in my life of practicing, but I've never seen a retroactive change like this for this type of purposes in the past. And this is huge. I mean, we don't know if it's going to pass that way, but they certainly put verbiage in the Green Book that may cause it to go that way. And this is it's very important. It's to be addressed, and we'll go into it deeper for some recommendations regarding this. Next slide, please. Another key considerations or tax considerations. Most of you are familiar with the pass-through income, the QBI, which we call QBI, which is a qualified business deduction, where under the prior administration, they try to give a break to the pass-through type of companies to try to equalize the corporate rate by giving you a discount of up to 20% on pass-through income. And there were some limitations. Some of them had to do with W-2 wages. Some of them had to do with the type of business. Some of them had to do with the assets, the amount of assets you had. But there wasn't a limit per se on earnings by themselves. So basically what they're saying now is that potentially it's going to be eliminated for people earning over 400,000. And of course, that's assuming that you qualify for all the other QBI deductions before, but essentially you hit the 400,000, it pretty much goes away. This is an item, this is important because before we try to equalize corporate rates, and now without this, you won't be able to. And this is all in the context of how do we plan in the future for a better structure to try to minimize the net tax effect. As to the corporate tax rate, as we all know, is 21% currently. It's set to increase to 28%. However, we've seen Senate people talking about a possible 25% rate. We don't know how this is going to end up coming up, but we are actually hopeful that it will be a 25% rate. And if not, it'll be somewhere between 25 and 20. That's basically where we're at with that. GILTI, I'll let Ray elaborate a little bit later on this, but basically GILTI is a global intangible tax. And it basically applies to people with foreign corporations or foreign controlled corporations that have retained earnings in them and a tax to it. We'll go into it deeper, but essentially for corporate taxpayers of the GILTI tax, where they enjoyed a deduction to take it to 10.5% rate, that's no longer going to be available. It's going to be 21%. And we have the CBC, which is a country by country, which we'll go deeper in a second, Ray, we can go over it, but it has to do with allocating income and losses with different countries in different buckets. Carried interest, that's typically for hedge funds or management funds or anything that has a management of some sort of funds where the managers or the general partner or the money managers benefited from a 20% carried interest, which if you remember the slide before, 20% is a capital gains rate, which was a good rate. That's said to be going away. Again, all of these changes are effective for next tax year, starting 2022. The only one that potentially is a prior 2022 change is the one we mentioned before about the capital gains. The next slide, please. All right, so now we're getting into, just before we go into this,
I want to just ask a couple of questions for the benefit of those individuals that deal with foreign clients.
Yes.
That is, if the tax rate now, it may go up, let's say for all intents and purposes, because there seems to be consensus on 25%. It seems that practitioners as well as taxpayers should now, if they're coming into investments in the United States, consider the corporate C structure, because it seems, and it's an individual analysis, that if you're combined, let's say for instance, it ends up at 25% in Florida is another 5%. So let's say 30% versus 39.6%. It seems on its surface, and that all depends on which states you have your different investments. If it's California, New York, so on, Texas. But it seems on the surface that partnerships right now, as you know, we use a lot of two-tier partnerships coming in, may in fact be a way of the past because of the benefit of the difference in the structure.
Well, yeah, you hit a great point, and to try to simplify it is as we all know, we use the two-tier partnership, which is basically two partnerships, and then the foreign individuals. if you recall my prior slide about the 20% tax rate, typically we use those two-tier partnerships for two reasons: to avoid or to minimize dividend tax in one way, but also to take advantage of the capital gains on the exit. But now if that capital gain is 20%, it's not 20% anymore, and it's at 39.6 for those individuals that are in a two-tier partnership where, and this is an item that we don't know how it's going to be interpreted, but allegedly, if you made more than 500,000, because as a foreign individual, you're considered married filing separate, you wouldn't be able to benefit from the 20% tax rate anyway. So there's certainly planning, or at least considerations, to be made in every structure that we currently have, but certainly the partnership one, if the purpose of that was to take advantage of the capital gains, and you're expecting capital gains to be greater than 500,000.
Yeah, Alberto, to Ray's point also, if you still were the individual rates because of the pass-through entity, you might become even more treacherous by going over the $1 million level, which then potentially, and we don't know yet because there's no specificity about it, but it may mean that everything is going to be at the highest rate, including capital gains or everything.
Right. Yeah, because you may foreigners on their gains are they cannot file married filing jointly. So potentially you may have two NRAs that both exceed $500,000. So they're both taxed at the highest rate in the land. So, you know, it's a point that clients have to look at, and this is something we're looking at. The other point that I just want to touch base on, which is the GILTI. We know we have a considerable amount of clients in Colombia, Mexico, and Brazil, as Argentina, that we deal with the GILTI regime. You know, the dividend received deductions effectively out of the way, but the more critical one, which is really on its surface, most people don't realize, is the country by country new limitation. And that is, right now we group all of the foreign tax credits worldwide, and we're able to use those foreign tax credits as long as they fall into different baskets. So, but now they're saying, for instance, if you have Colombia source income, you can only use Colombia taxes against your Colombian source income. If you don't have more taxes, those foreign tax credits get carried forward. And so you cannot overlap them into another country that, in fact, you may have taxes to owe there too. The other, and that's a big planning tool for us. So for instance, if we have clients that have an appreciated property in Colombia and they have businesses outside Colombia, we may check the box to trigger the gain because we know we have excess foreign tax credits in other countries that are passive in nature, and we offset that against the check the box gain that's being triggered. That tool and the arm is no longer going to be available on the country by country exception that they're trying to do. And on top of that, they've also have eliminated the high tax exception, which is also a major planning tool that we use at all. So a lot of our clients benefit from the high tax exception because in the US, their effective tax rate is maybe, 21%, but in their country, it's maybe 35%. So that high tax exception is really critical. So that's going to be repealed too.
Continuing with the estate tax changes, here I need to clarify this part at least. This is not on the Green Book. This is just on Biden's campaign. So this is what we think is happening as to specifically this slide, but on the next slide we know of other changes that are specifically to estate and gift. Very briefly on this, because again, this is just, it was on the campaign, but it's not on the Green Book. It has to do with the estate and gift tax rate going up to 45%, the unified credit, which is currently 11.7 million, and it's supposed to revert back to 5.5 million per person in 2025. We think, based on commentaries and the campaign itself, that it may go down to 3.5 million per person. Again, this is not law, this is not in the Green Book, but we think it's going to happen. This particular item, this next item, this data death basis step up. Let me just explain this now so that we can go into the next slide, because this is very important. There's two types of bases that you hear as accountants talk about, which is carryover basis and stepped up basis. What's the difference? We always confuse clients with this. Everybody gets confused with this. The best way I can put it is with just a simple example. Let's assume I bought a share of Apple for $1. That's my cost basis. Well, I added a third one. So we have cost basis, carryover basis, and stepped up basis. So my cost basis is the $1 that I paid a share for it. Under current laws, if I give that share to whoever I want to, and we're not talking about gift taxes right now, we're just saying just to the simple transfer, I will transfer that share, let's say, to my son, and he will get carryover basis, which is $1. It's a share that now it's worth $100. So when he sells it, he's going to pick up that taxable income. However, if I died, instead of gifting it, he inherits it, he gets it at $100, which is a stepped up basis. There's no tax in that step up. Okay, and we're talking about the income tax consequences of gifting or dying. And then, so what it says about no step up is under the new regulation, and this is in the Green Book, and I think it's on the next slide. Can we go to the next slide, please? What's going to happen is, yeah, there we go. So what's going to happen is that $1 of Apple share that I'm gifting to my son or inherit now, it's going to be subject to income tax on the difference between the $1 that I pay for it and the $100 that it's worth now. So in essence, when people saying you're not getting a step-up basis, he will get a step-up basis. My son, in this case, will get the step-up basis, but he's going to have to pay for it. Actually, I'm going to have to pay for it on the step-up from the difference between 1 to 100. So $99, I'll pay the income tax. My son receives the share at $100, whether I die or I gifted him, and now he has it at $100. This is huge. This says, I haven't seen this before. And it talks about gifts, transfer, bequests on anything. This means that any transfer, essentially, or potentially, depending how they end up writing the law, will be subject to income tax on the actual transfer of that asset. And again, I'm not talking about gift tax or estate tax. I'm talking about income tax on a gift or on an estate. We'll get into the estate.
And this is a game. This is a game changer for a lot of our of planning for foreigners. You know,
Yes.
and we'll get into that. But this is I mean, the brunt of this Tax Reform Act is going to affect a lot of the foreigners on this.
Yeah. Let me give you a simple example on a foreigner, as with the current law and the new law. Let's say you have a foreign person, individual, with no planning, that bought a condo in Miami, let's say. Let's say he paid $100,000 and it's now worth $300,000. And that person passes away today. Well, under current laws, he would be subject to estate tax on the $300,000. And then his heirs will get that property, pay the tax, whatever that is. And then his heirs will receive that apartment at $300,000. With the new law, he's going to have to pay income tax on $200,000, which is the $300,000 fair market value minus $100,000 he paid. And now his heirs receive it at $300,000, but he also has to pay estate tax on the $300,000. Now, allegedly, there's a deduction for the income tax paid. We don't know how that's going to interplay. But as you can see, where before you only had estate tax, now you have an income tax and an estate tax.
And the Green Book is not clear. You know, there's a $2 million exemption for capital gains. It's not clear whether it's applicable to foreigners. So
That's correct.
This could be a double whammy on an individual that owns, let's say, a foreigner owns an apartment in Texas, and he owns it outright, and he dies.
Right.
Potentially, it's a devastating event
Probably your
for
worst
family.
scenario.
Yeah.
Let me mention
And
one
we'll-
other quick thing about foreign
Yes.
issues, just quick, and we'll probably talk a little bit more later about it. For those who are not familiar with the estate exemption,
Oh, yes.
you know, we quickly brushed over this $11.7 million for US persons. For non-US persons, basically it's $60,000. I mean, that's devastating, and that's existing law. So you can imagine if there's a double tax on top of it, it's going to drive a lot of capital in other places.
And then I think this is the last thing on actually this change is related to transfers. This 90-year mark to market. This again, I haven't seen this. This is on the Green Book, and basically where they're saying it has to do with bringing the value of a property to market, and of course taxing you on it. This is for the big legacy trusts or the big partnerships. That's, I don't know, like me an example. I don't know, the AIG building downtown or something like that, where it's been transferred from generation to generation on a family limited partnership or in some sort of trust. What would happen is, let's say they bought it for X amount 9 years ago, and that period starts counting from January 1st, 1940. 9 years would be December 31st, 2030. What this means is that if you haven't sold that building by December 31st, 2030, the IRS will kindly tell you that they're going to assume that you did at fair market value, and you're going to have to pay that tax. I haven't seen that before.
Less your cost, your carryover cost basis.
Less your carrier cost basis, which potentially were nothing, right?
1.38.
90 years ago. So this is huge.
Yeah, this is
I
huge.
can't wrap my head around this.
You know, for planners that family limited partnerships, revocable trust. Revocable trusts that ultimately become, pass-through entities. I mean, there's a lot of issues that are taking place here. So, and we'll get into it further. And again, we're briefly brushing on this. We could spend an entire day just alone on the gifts, bequests, and the realization of events, because it's a combination that's affecting both U.S. people, U.S. persons, their citizens, residents, or fiscal residents, or now it's a new caveat for foreign individuals. The planning's still there for foreigners, but once those foreigners die and that becomes a beneficiary to a U.S. Benny, then we have this becomes an issue.
I
Correct.
can tell you, as the elder statesman, I practiced in the 70s and 80s, and before all the stepped up basis was a thing, it was a nightmare. Everybody was thrilled about the stepped up basis when they allowed it, primarily because it made a lot of sense tax wise, but internally it was an impossibility to track, because we were looking at 20, 30, and 40-year-old records of 2 and 3 generations of families owning assets, and where, what did they pay originally is almost the easy part. It was then how many improvements did they make, and it was a nightmare. I'm hoping that nightmare will be one of the reasons that there might be a deterrent to some of the passage of this realization event, because I think it's probably the biggest catastrophe of this whole proposal.
Yeah, and if you stop and think about it, most of all this real estate, if anything, has been fully depreciated. It's
Right.
basis is
Right.
completely zero. What you have is land.
This will also, I just wanted to point out, this would also affect the common planning tool, the internationally defective grantor trust, which is a technique used for wealthy people to move money out of the state. And typically they don't pay income tax on that transfer because they're considered one and the same.
Correct. Okay, we'll move on. The next slide, please. This one has to do with valuation discounts, and I think, Ray, I'll let you take it. I don't know if you want to do this one now, or
I could do it. I mean, we use valuation discounts as a form of planning tool. This is an interesting proposal, because in essence, for purposes of gifts. So to give you an example, if we have a gift of of a piece of property, and we are going to put it into a family limited partnership, and I'm going to go ahead and make that gift of the partnership interest to a U.S. person. Normally, what you do is you go through the process and make sure that the limited partnership agreement has basically certain caveats that limits the controls of the limited partner. And so what that does, it raises whether there's a lack of marketability, a minority discount, and you're able to a lot of times drive down the value for purposes of not getting into your exclusion. So what they're saying right now is, in essence, listen, for purposes of determining the capital gain on a gifted property, you cannot do any type of discounts for purposes of determining your gain. That's a brutal, estate tax planning effect. So the good thing is we have until December 31st of 2021 to basically effectuate any type of gifting and transfers before this hits in. Obviously, there are exceptions. You still have the unlimited marital deduction. They also have, if you make transfers to a charity, so you're able to still do that. Charity will in essence have a carryover basis. There's a new $1 million portability per person. That's the $1 million that I was mentioning that, when we split the estate tax with two people may have died that are foreigners, it's unsure right now whether foreigners can use that $1 million each, husband and wife that each independently died. Tangible personal property, basically that's still excluded. Family-owned businesses, the Green Book makes mention of it, but it does not define what is a family-owned business. I suspect that this deals with farming because right after you begin to see, they're saying a 15-year deferral. That's what that provision is basically made for a lot of the middle America, because for instance, if you're a farmer and you're sitting on 100 acres and you cannot sell that 100 acres because it's illiquid, the IRS is simply saying, we will give you a deferral period of time to pay this. So it's trying to balance what we call as a family business, a family farm, and but again, family-owned business is still not defined. I presume that once they define it, we will all be, trying to chip away to splice the businesses into smaller businesses, I guess, to get around it. But who knows what the final product is. Losses and offsets, you could still use losses and against offsets against capital gains. That's still in play. Qualified small business stocks under 1202. It's not applicable with respect to discounts. I'm not going to touch upon that. Eric has 6 or 7 slides on that. It's an excellent planning tool for IP companies, intellectual property startups that have substantial assets that could be sold. The other point is, we have exporters. A lot of the exporters that benefited from the 13.125% tax rate, that's going to go out the door. That's a really major blow to exporters in the United States that export abroad, because it's a great incentive for exporters. It helps them finance receivables that otherwise a lot of times it takes a lot longer time to collect sometimes. So then they're offsetting that by R&D. Well, R&D credit is a certain level of clients that that is totally geared towards a different type of business, that's IP. You can see that this Tax Reform Act is trying to go after a lot of improvements of energy, intellectual property. So they're trying to stimulate a lot of the R&D. This one, in my opinion, is going to affect a considerable amount of the real estate throughout the entire country, and it's eliminating the 1031 in excess of $500,000, and that, in my opinion, is a major blow to the industry, because 1031 is a great tool. to use. Just simply, sometimes two partners, you know, want to roll over to a much larger property, and it makes sense. So the third one, I mean, nobody likes to hear this, but I mean, obviously, we're going to see an uptick. That's an $80 billion proposal, $8 billion for a year for 10 years for enforcement. And, you know, although the Biden plan has said that they're only going to go after, you know, people that make more than, you know, $400,000. I mean, we all both know that who are in this business, they go after everything, anyone, anytime. So there's no mercy at all. So, you know, I would caution, you know, as we go forward, because we're going to see a very aggressive IRS enforcement arm coming down the pike here, especially in South Florida, Texas, you know, where there's, you know, all over where there's international, because international is the largest pop for the bang for the buck for the IRS. The 3.8%, many of you may have S corporations. You know, you've had this grace period for years that you've never taxed your 3.8% on your distributions from S corps. Those days are over. You're going to be taxed on them, no different than a partnership, especially if you're a general partner on it. You know, the same applies with respect to the itemized deductions. You know, there seems to be a theme that anybody that makes over $400,000 is a millionaire. So again, your itemized deduction, if it exceeds that, you have a cap of 28% total. So, and then payroll, as payroll is going to be interesting because, you know, right now you have certain limitations up to a certain amount. They're basically saying if you basically have payroll where they're expanding on any wages above $400,000. Qualified opportunity zone, we'll get into that one. That is a lot more trickier because a lot of our clients are now wanting to break the qualified opportunity zone, but in light that the capital gain is in fact you know, taxable in 2021 potentially, then that's put a hamper on it. But we've had some clients that were effectively able to break from the qualified opportunity zone. We've been able to work with certain clients on that. And finally, the 1202, Eric will touch on that. I don't know, it's a great incentive. He'll teach and he'll go over everything. We have 2 slides on this, but and we'll go to it right after this. But basically, you know, when we're looking at recognizing professional goodwill versus enterprise goodwill, we a lot of times planning considerations if you're selling your company. So let's say, for instance, you have an IP company, and there is a enterprise value that they've placed on it, but that company a lot of times has a professional goodwill because the executive has a manpower value, and so he is the brains behind it. So a lot of times what we do for planning purposes is we first value the company, and then we carve out what we call is the professional goodwill. Then for purposes of selling, we carve out then the sales price or the allocable sales price to the company versus the allocable sales price to the individual. The individual, if for instance, in a C corp would not be subject to a double taxation. He would only be subject to a single taxation on his personal capital gains. The second one is electing out of installment sale. This is an interesting one. Actually, we had a very large Brazilian client that Rosa and I worked on together that in fact came to this country, and basically we elected out of installment sale for purposes of taking the tax treatment on that. The other point is if you have a client that has an installment sale, I mean, now's the time to elect out. The election is an electing out, but you'll be taxed at 20% as opposed to 39.6%. And that's a huge savings, especially for a client. There are other tools that, you know, that could be used, you know, to accelerate your gains if you're sitting on potentially an uncollected gain from a sale or an uncollected gain from an appreciated property. Can you go to the next slide? This is Eric. This is your.
All right. Thank you, Ray and Alberto. Hello, everyone. Thank you for joining our webinar. While Alberto and Ray touched upon all of the changes that the Biden administration is proposing, I'm going to discuss a planning tool that's been in place for many, many years and is not really well known and underutilized. And while most of you are familiar with various tax incentives and buzzwords such as 1031 exchanges, opportunity zones, et cetera, the IRC section 1202, which is known as QSBS, or Qualified Small Business Stock, it's one of the least recognized internal revenue sections, which has been around since the 90s. It provides one of the most powerful tax benefits to entrepreneurs and investors and has gained a great deal of interest recently, especially with the federal corporate tax rate being reduced from 35% to 21%, which obviously may increase, and the possibility of capital gains taxes increasing from 23.8% to a maximum rate of 43.4% for high income earners. Any potential increase in the federal tax rates, as Alberto discussed, would make a qualified small business stock tax exemption even more valuable, both as a way to attract new capital from investors and as a wealth planning tool, especially for many small businesses affected by COVID. While 1031 exchanges are utilized for real estate transactions and they simply provide deferral of taxes, the section 1202 qualified small business stock is utilized for active operating business investors, along with private equity and hedge funds companies, and they enable you to exempt your capital gain income up to certain limits upon the future sale of your qualified small business stock, which we'll get into later. So simply put, imagine owning stock in a company where the price appreciates greatly, you sell it after 5 years and pay zero tax on the gain. And that's basically what can happen with a qualified small business stock. So to give you an example before we get into the brief overview, comparing an S corporation or a pass-through entity with a qualified small business stock entity. Assume a shareholder had $2 million in tax basis in an active trader business, and 6 years later, the shareholder decides to sell his stock in the amount of $20 million. As the shareholder of an S corp, the individual shareholder would currently pay 20% on the difference between the 2 million tax basis and the 20 million sales price, or better said, 20% on the $18 million gain for a total tax due of roughly $3.6 million. So now, assuming the same fact patterns, this entity was set up as a C corp, as a qualified small business stock, meeting all requirements, and the shareholder has the same $2 million tax basis. In this scenario, the $20 million gain would be tax-free, since the shareholder can exempt a greater of 10 times the adjusted tax basis, or $10 million. Since the $20 million in this example is greater, the entire gain would be exempt from taxation. And any gain above the 20 million would be taxed at 28% under the qualified small business stock rules. Okay, so the brief overview, you can exclude, as I just mentioned, $10 million or 10 times your basis of stock sold. The gain exclusion is per shareholder limitation, so the total exemption to the shareholders can be astronomical. It's not just the $10 million or 10 times one shareholder stock basis. Some of the requirements to qualify for a qualified small business stock are you need to be a qualified small business stock. What does that mean? It means you have shares in an active C corporation. You cannot have more than 50 million in gross assets at issuance. You are engaged in a qualified trader business, as we'll define later. And the company uses 80% of its assets in an active trader business. Also, you have to hold these shares for more than 5 years. There is an exception to that, which we'll see below. This is not available for C corporation sellers. What does that mean? That means a C corp cannot be owned by another C corp. Regarding the 5-year rule, the gain recognized on a sale of qualified small business stock held for more than 6 months can be rolled over to another qualified small business stock. So sometimes a company sells prior to holding the stock for 5 years. This is an exception, which allows an investor to roll over their investment and gain into a new qualified small business stock to avoid taxes on the initial gain and continue qualifying under the gain exclusion for future gains in the new company. Okay, the $50 million maximum asset value. So one requirement to qualify as qualified small business stock is the 50 million asset test. It's based upon the adjusted tax basis of the assets rather than the fair market value. This applies at any time at or immediately following the issuance of stock. And the company can subsequently exceed the 50 million asset test, but no additional qualified small business stock can be issued by the corporation at that time. So once you exceed $50 million, you can no longer issue any additional shares in the qualified small business stock.
So Eric, you have to have, for when you first issue your shares,
Yes,
your basis, let's just discuss for as a general, your retained earnings, your basis, let's just discuss as an example, would have to be less than the 50 million.
correct. Your gross assets would have to be less than 50 million from the time this company was formed to the time you issue shares.
Okay,
Or
so
additional
then at that point in time, you have original issue stock, less than $50 million in assets. Consequently, you now can qualify as a 1202 first step towards your potential gain if you sell this thing 5 years later.
Correct. One thing that you need to be aware of is that if you have just under $50 million and you issue stock of, let's say, $10 million, you will be over the $50 million threshold and will not those shares will not qualify under the qualified business stock exception.
So if you're doing tranches, raising money, seed round A, B, C, D, there will, everybody has to look at one point in time, you have to look at those seed rounds if you're able to meet that assets.
Correct. And this needs to be monitored from inception to the time you continue issuing additional shares, either common, preferred, et cetera. And I think that kind of goes through the fact patterns above, so I'm just going to skip that. One comment to make is the original company was not a corporation when the assets were greater than 50 million. The stock could qualify as a qualified small business stock if the assets were less than 50 from conversion of partnership to a C Corp immediately after stock issuance. So basically a transfer from a partnership to a C Corp restarts the holding period from conversion date, and any appreciation in that LLC prior to conversion doesn't qualify for the exemption. So it would just continue to be your initial capital investment. One of the requirements, as we discussed above, is that it must be a C corporation. Obviously, there's the exception of converting a partnership to a C Corp, but they do need to meet that $50 million exception, and it has to be initial shares issued. It cannot be a partnership, S corporation, et cetera. So certain C corporation structures are excluded, such as regulated investment companies, REITs, domestic sales corp. All of these type of entities have preferential tax treatments, which is why they're excluded from the qualified small business stock. As Ray just mentioned, it needs to be original issuance of shares. It must be stock issued after August 1093. That's when this tax reform came into place. And it must be the original owner of the shares. So the original of the shares, meaning the shares must be acquired directly from the company at original issuance. For example, you cannot purchase shares from another investor. There is an exception allowing you to gift shares or transfer shares at death, and the new shareholder would step into the shoes of the transfer with respect to the stock basis and holding period. And this is very useful in family wealth planning to maximize exclusion limits. You can actually gift it to your child and potentially exclude 20 million instead of the 10 million cap.
Right, but the interplay of 1202 at this point in time with the transfer, that's going to be really interesting to see if there was a bequest or an inheritance.
Right.
As of now, I believe it's excluded from the capital gains tax.
Or a realization event on the new
On the realization event, exactly.
That's a
Next
nice-
slide.
Okay. You need, in order to receive the shares, it needs to be in exchange for money, property, or services. In the private equity world, services is a very useful tool for startups who are short of cash, and it's a good tool to compensate employees with stock options and would still qualify under the 10X or $10 million exclusion. Okay, next slide. Okay. As we mentioned already, that a C corporation cannot be owned by another C corporation, must be stock issued to an individual, trust, or a pass-through entity. Some of the basis requirements we also went over at issuance is it cannot exceed $50 million at any time between 1993 and the time of the taxpayer's investment.
Eric, I think if I may, just to clarify, you mentioned that it had to be an active trader business. I don't think we touched upon, but if you did, if you can clarify, for example, real estate or services, those wouldn't apply, would they?
No, and we'll get into that. I believe it's on the last slide.
Okay, sorry.
No problem. The issuing C Corp must conduct an active qualified trader business, which is what you just mentioned, I believe is on the last slide. But it must meet both the 80% test, which means 80% of the corporation assets must be used in an active trader business, And the corporation must be a qualified trader business, which is what Alberto just mentioned, and we'll get into on the last slide, which are entities not specifically excluded, as we will see in the next slide. Okay, I think we skipped over some. I think we skipped over one of the slides. If you want to go back. Okay, so certain startup activities and research and experimental activities may qualify. This is really an exception since they aren't engaging in an active trader business during startup or research and development, but developing activities for a future active trader business.
Yeah, and I think to clarify, the reason we're touching on 1202 is since everybody in the entire country is going to be hammered on 39.6 plus 3.8. So the second question is, how can I retool my existing businesses in such a way, you know, that down the road, as I start a new business or I start a new venture, that I could go ahead and go through this process. You know, so if you're giving a gift to a child now to start up their new business, well, maybe this would be the best way to transfer wealth to your kid, because in essence, you're giving and then you set it up in a way that he or she will be able to benefit from the 1202.
And previous law only allowed you to exclude 50% and 75% of the gain. And more recently, it was changed to 100%. So with corporate tax rates being 21% currently, it's a huge planning tool. That's extremely underutilized. There's two 10% rules that would disqualify you. One is that you cannot have 10% of the value of assets consisting of stock or securities in other corporations if you have less than 50% in those corporations. And you also cannot have more than 10% of the value of assets consisting of real estate if that real estate is not used in a trader business. There's a working capital requirement. You must be able to document the business needs of excess cash, or else it can count against you for purposes of that 80% test that we just discussed. Okay, and then let's go the active trader business. So as Alberto mentioned, interestingly, there is no specific guidance as to what industries qualify as active trader business, but there is guidance excluding specific industries. So the type of industries that typically do qualify are technology companies, retail, wholesale businesses. And then as you can see on the list below, it's quite extensive. But any business where the principal asset of such trader business is the reputation or skill of one or more of its employees would be disqualified. Any banking, insurance, financing, leasing companies, any farming businesses, any business of operating hotel, motel, restaurants, or similar type businesses, those would all be disqualified.
So Abatos is not qualified.
No.
Correct. Unfortunately, the attorneys, the accountants do not qualify.
Unfortunately, it isn't.
The architects.
Again, I think they haven't touched 1202 because I think they're trying to stimulate a lot of the intellectual property movement and back.
Yes, I want to move it back to the United States. Correct.
And this not to basically harp on it more, because this is basically what I was discussing earlier. Your typical professional goodwill transaction. That basically there's a case law there where we apply that goodwill basically to an active person owner. He would be subject to only one level of taxation, and that's a great shining pool. We're trying to see a lot of M&A work. So you have to determine whether you have what type of value, not just value that's customers. If when you start getting into, and they say to you, a non-compete, well, what does that entail? Or the client has a certain expertise on running this type of business like that. So, in an M&A, this is a great planning tool. Next slide. This goes back to electing out an installment sale. This is your typical example that we had. Basically, we got cash for $60 million. And at first he thought that $40 million would be great. He was deferring it, your typical boilerplate sale where you have an owner that has a deferred payment plan. But in this case, we were able to convince the client that electing out of installment sale would be the best bet right now. And we are paid the tax of the 20%. And then we basically are going to not be hit whether it's this year, since it's an installment sale. Once the law changes, as he's getting his payments, he'll be taxed at 41.8%. So it's a great tool. Again, this is all about planning and so on.
An additional quick note on electing out, it's also an immigration planning tool. That's not used very often. So, because we do a fair amount of that in this practice. And for those folks who are about to enter the country who have an installment sale that would be recognized as one, if we can recognize the fact that they can elect out prior to them coming here, they'll receive all those principal payments subsequent to becoming a U.S. person, tax-free other than for the interest income that they receive. It's a great tool.
And that's a great point, Elliot. And I mean, we have very little left on the process. And the biggest thing, I guess, and if you want to touch base on the gift and bequest, because that's we've touched upon it a little bit, and then we could all just open it for questions because we have about 9 minutes left.
Okay, I'll be quick. I just want to thank the participants and everybody else who's here, and thank you for leaving the death tax to the old guy. Appreciate that. Anyhow, really what's happening here is we've always been planning for how to maximize or minimize, if you will, the effect of a estate tax on individuals. I think that the focus here is almost in the sense of a vendetta as a focus of a target for this administration. So it would seem to me that the wisest thing to do is accelerate that which we have and take advantage of it while we know we have it, a bird in the hand, so to speak. The $11.7 million exemption that everybody has individually or jointly, twice that amount with a spouse. I think it's really time, if you've been thinking about gifting and doing a lifetime gift versus waiting for the estate tax to happen post-death. Now's the time to really do some thinking about it. As you may as you know, gift tax and estate tax are joined in effect. There's a transfer tax in America that's really based on our heritage of the king used to own everything, and you needed permission to transfer anything and or pay the dues. And that's what this is all about. So the things that we're saying is utilize as much gifting as you can. There's a whole lot of thoughts to be done. I don't want to get too crazy because we got a little limited time left, but there are a number of different types of trusts that I would say we should look at or think of, speak to some of your advisors with respect to setting them up and getting them in place before a lot of this stuff comes into vogue. There's spousal trusts, there's charitable remainder trusts, all of that gift planning type of thing with the appreciated assets. You've heard about the disaster and the really horrible event, this realization event that they invented for this new concept. We really need to think strongly about making these things and doing them now. I know we're short of time, so I don't want to get into a whole lot of it other than there's a number of various things that we can do and should do. Please let us know and we can consult with you on your specific situations. But surely if you're thinking of doing giftings, thinking of forming trusts, now would be the time to do it. The other thing I want to mention is, it's been sort of touched on very quickly, for the international clients, the non-US people, the estate tax is far more treacherous than it is for the US people. So it's really important to get the right structure and consider whether or not the C Corp situation still works, even though with a 25% rate that they're talking about, it still may be more advantageous than the pass-through entity that's been in vogue for the last 10 years or more with partnerships, et cetera. because the maximum rate there is 39%. And we could be triggering that percentage rate when you drop in your capital gain on the one apartment that you had on Brickell Avenue. So I don't want to take any more time. I'll leave some time.
Well, let me just, so just before I want to summarize so everybody understands from, your traditional BVI owning a US corporation, and the BVI is owned by a foreigner. As if the foreigner dies, that blocker is still in place. That's still a good planning, because the step up is inherited between the BVI and the US entity. The US person will inherit the blocker, but the step up in basis at that point is not going to be affected, because you have a non-US blocker in place. That is still, viable, no different than, you have a foreign grantor trust that's still there. So the second part is, once that person then wants to sell the BVI stock, where that's going to be your hit.
Right. So that is, if I may add, that's the typical structure with the blocker that
Right.
most of us practitioners use. That's still in play. As a matter of fact, it makes it actually better, because it will be the only structure that actually is not subject to the transfer tax, the immediate recognition of the income tax on that debt, allegedly.
Right.
Ironically, the very old advice
Yes.
20 years ago.
And to add just to Alberto's situation, for the first time, going back, you have, let's say you have a gift, and you gift the shares to your daughter in the US. That gift, if it's US situs,
That's an issue. Yeah.
that's a transfer tax, and you have a problem there. If the person dies, the same example. So, and like I said, it's clearly unclear on the $1 million exclusion. The other point is, for the first time, transfers into a US partnership, it's unclear whether that transfer contribution is a non-taxable event.
Right.
So, when we're talking about corpse, we have a blocker. Then the issue comes in, what about changes in the trust, or what we call is non-corporate vehicles, like a partnership? It's fairly clear. For instance, we have clients that have foreign grantor trusts, that you have a person, you have a US Benny, and you have a non-US Benny. Those transfers in and out, to the extent of could be taxable to the US Benny, because he's taking in and out from the foreign trust. So, the foreign grantor's trust is still usable. It's a great tool. If it still has publicly traded stock, cash, that is still not. But anytime when you have any type of US situs company, or a US situs personal property, you have to start thinking at that point in time, did this transfer create a taxable event? That is crucial, because before it wasn't. For instance, a non-recognition gift,
It was
may
clear.
in fact be a problem. So that's where your transfers come in. And then and lastly is, I think for the first time, as Alberto mentioned, someone dies, they may get hit with both. And there's ways to plan all this out. But at this point in time, it's just the Green Book. The Green Book is sort of like your boilerplate. Until we get to the details of it, we may not know. For instance, Elliot mentioned a charitable gift. Charitable gift, if it's part to the person, part to the charity will receive a carryover basis. But you're transferring to a charitable trust, it's a taxable event to you. So you split your trust in half. So, those are things that you got to start thinking about. I don't know if we have any questions. I know we went through a lot, but I'm sure if anybody has any questions dealing with these subject matters, we'll be more than happy to address them offline, everybody could, you could always call us and we'll be more than happy to assist you. With that, thank you very much.
Thank you very much.
Thank you.